Excellent. So welcome everybody. I assume that we are getting more and more attendees coming in, which is fabulous. But just just a really quick hello and welcome to this session. Hopefully it will be interesting. It's not too structured, it's a bit informal, so who knows what's going to happen. I'll try and moderate my language. That might not happen either, but I'll do my best. But the topic in hand here is delivering the A round. And it's always a massive pivotal point for a company where you go from having a bit of traction, things are starting to go well, people are starting to take interest in your business. How do you make sure that when you do that first Series A fundraising, that it really kind of is what you want, goes well? You know, what are the important things to think about? You know, we can often think this is all about money, and hopefully this session will tell you it's not all about the money. There's a lot more that goes into it, and you know, chances are you're going to be stuck with your VC for many years, so you better like them. So that will do. Just a few kind of formalities. If you would like to ask any questions, please use that chat box there to put those questions. We're not going to get through all of the questions today, hopefully, if there's lots of them, but we will try and answer them afterwards. But I will try and pick out some good ones. So the format will be roughly, I'm going to ask, or we're going to together introduce sort of 4 or 5 topics that we think are sort of pivotal for Series A rounds, and then we'll go to the chat, the Q&A, and see if there's any more things that we haven't covered and answer those. But before we start, and we'll keep them hopefully a bit short, let's do some introductions. I've spoken enough already, so I will go last. So looking at my box, let's look at Greg and get an introduction from him.
Thanks, Ed. Yes, hi everyone, I'm Greg Carter. Over the past 10 years, I've been fortunate to see both sides of the table, first making early stage investments at a corporate venture role and then at a family office. And then I switched to the operator side, leading an SME lending firm here in the UK, where we raised over 10 million at Series A to scale our tech and growth. I'm now the CFO at Capdesk. We're the leading shareholder management platform in Europe, supporting founders, CFOs, and general counsels from companies like Nutmeg, Seeker Escapes, and Curve, with our tools for cap table management and employee equity schemes.
Excellent, thanks, Greg. So very much the hands-on operational. He's had to deal with people like me, unfortunately for him. So let's move on to Ali and get an introduction there.
Thanks, Ed. Pleased to be here. So my name's Ali Ramadan, and I'm a venture capital and M&A lawyer at Goodwin Procter, and I've been working with tech companies and investors on venture capital financing transactions for about 10 years now. So I kind of see both sides of the table, and I'm looking forward to today's discussion and the insights that come from it.
So yeah, proof that there are nice and friendly lawyers out there if you look hard enough. So good to have Ali on board. And Sarah.
Morning, everyone. Yeah, thanks. So I'm Sarah Abrahams, Head of Raising Finance at Cooper Parry, and I advise and project manage fundraisings from seed to Series A. So spanning that spectrum of startup to scale up capital. And I've been doing it for about 12 years now. So over that time, I've helped to shape about 400 early stage fundraisings across all sectors. If it's tech, you know, all applications from health, regulation, HR recruitment, fintech. If it's on the sort of bricks and mortar side, I've done everything in consumer, right through to an axe throwing business. So I really have seen it all. And yeah, delighted to be here today.
Thanks very much, Sarah. I actually looked at that axe throwing business, and yeah, it was far too scary for me to get involved. I just would never want to do the site visit, so passed it by. But yeah, so just very quickly, introduction to myself. Edward Keelan. I'm with Octopus Investments. I've been at Octopus for 12 years, which is quite a sentence. We manage around about 9 billion in total, all sorts of things, renewables, property, but what we're most known for is our investments into smaller companies. So things like Seeker Escapes, Zoopla, SwiftKey, Kazoo, Calistone, etc. And the team that I work in specifically, we look at sort of larger Series A rounds, generally where we're the lead investor, but focused on B2B software. So my pitch, and gosh, don't tell me off for this, the rest of the panel, but if you are looking for Series A investment and you need a bit, then feel free to drop me a line on LinkedIn. That's my sales pitch done. So I think we should go straight into the topics. The first one that we wanted to talk about, there's also a lot of advice on what you should do and what you can kind of do right, but I think an interesting way of looking at it is what you can do wrong. And so what are the big mistakes that people make? And I'm happy to kick that off from an investor point of view. And so for me, the biggest mistake that I see companies make, I think, in when they're raising Series A, is that I get a 50-page slide deck, which I largely don't look at. And then we talk about the figures and the numbers of what's driving the business, and maybe the company's less prepped to do that. So, what I really want a company to do is think about unit economics. What are your KPIs? What is driving your business? How do you grow that business, and how do you do it in an efficient way? So sales efficiency metrics. What's your LTV to CAC? Is the TAM the right? Is being looked at correctly? So I think if I could say one mistake, it would be too much focus on the kind of pictures in the slide decks and not enough focus on the substance in the unit economics. So that's my view. I don't know, Sarah, from an advisor point of view, what do you see?
Yeah, I mean, a great one there. I think for me, I would say it's getting into the mindset of a Series A investor and how that maybe differs from pre-Series A investment. And a lot, kind of leading on from what you've said, really, a lot of focus tends to go into explaining the ins and outs of the business and the product and how the product is evolving and how it's developing. But when you look at the mindset of a Series A investor, they're really looking to back something that's proven, that's being sold to customers, where you've maybe ironed out some of the inefficiencies in your sales and BD process, and they're wanting to back something that's already selling and doing well, but inject money into that to make it go further, faster, and sort of scale up that sales and marketing efforts. So leading on from what Ed said, the KPIs therefore are very important, but showing how you can really make your sales process efficient and how you can grow that and scale revenue rather than focusing on what you need to develop. Series A investors are about growing something that's already doing quite well rather than backing something that's still being proven. So switching to that mindset is quite important.
Cool, thanks, Harry. Greg, what are the mistakes you've made?
Well, we don't have long enough to talk through all of them, but I think one of them is a reflection I have of fundraising as a sales process. So just like a sales process, you have to identify prospects, secure pitches, qualify purchasing intent, negotiate commercials, move from commercials to legal docs, and then close. And just like a sales process, the bit that I've got stuck on a lot, and I think a lot of entrepreneurs get stuck on, is qualifying intent. Very often, VCs see thousands of deals, they'll invest in a handful of them, but in my experience, they very rarely say no, and they very rarely give clear feedback. And so a common mistake I found myself getting into is this conviction trap. Often you'll be talking to an investor, perhaps a junior member of the team or a new partner who seems really enthusiastic and keeps asking for more information, deeper analysis of competitors, more breakdown of unit economics. And this can keep going for weeks and then months. And in one case, I wasted 4 months with a VC before I eventually figured out the dynamics of the firm. He was a new VC, a new partner at the firm, and he just couldn't get enough conviction, both within his own mind and within the partnership's mind, to move forward to a full term sheet. And it really taught me the lesson of understanding the dynamics of the firm as a whole, and making sure that as you're going through the early stages of the relationship with a VC, to figure out where you are in that sales cycle. So understanding, has the VC got enough conviction to move into the next stage to convince his or her partners and move towards a term sheet. So yeah, that's been a very painful lesson and many hours wasted on my side.
So I'd like to say, by the way, if you ever come to us, we will always give you a straight answer and clear feedback. But I think it's probably a good moment to sort of And I never like to pitch advisors, but it's a good moment to pitch Sarah and the idea that if you have somebody that does this day in, day out, they can kind of understand that universe and they can read the signs, of time wasters versus people with true conviction. Ali, from a legal standpoint, what are the early mistakes that are made?
So I think from my point of view, it's sort of be thoughtful as to who you sort of approach and think about the investors you want to talk to. I see a lot of sort of scattergun approaches, sort of approaching everyone and sort of firing things out, and I get asked for lots of interest to investors. I think that's important. Think about the type of investor you want and who you're going to look at. And I think from my point of view, the legal point of view, it's like getting your right advisor on board, getting someone who understands venture, who knows the space well, because actually when you do finally get to the point where you're going to sign a term sheet, that's going to set the tone for your relationship, getting a deal done easy and quickly, and not sort of falling out of your investor and having these big fights. It is the way to do it, and a good lawyer can do that and help the founder get over the humps that they're going to encounter and the sort of issues they're going to understand, and do it in a way where you get to your first meeting and you're friends with your investor and you haven't sort of had a massive bust up in between.
Cool, thanks. So there's lots of pitching for Sarah's advice, and that probably gets us onto brings us nicely onto the sort of next topic that I was going to talk about. But before that, just another pitch. For questions, for those that have joined us, if you would like to ask questions, please just ask away in the chat box, and we will either come to those later or we'll answer those post meeting. I'd say this is a safe space. It's an opportunity to ask questions to certainly VCs and lawyers that maybe otherwise wouldn't get a straight answer from. You can now ask the question in the knowledge that you will, and there are no silly questions. Well, there is silly questions, everyone always says that, but there are definitely silly questions, and maybe this is one of them. So the next thing I want to talk about is which advisors are worth having. And before I kind of I think probably introduce Sarah to this topic, I just wanted to mention something, is that from a VC's point of view, the little secret is it's actually sometimes much better not to have advisors involved, because you then get kind of a free ride at the company that doesn't build competition, which makes it much easier for you. And just a direct approach where you can kind of keep the management team to yourself can be really useful in negotiations. So I'm doing myself a disservice here, aren't I, in saying that? But again, trying to be honest that what we want is that kind of that direct approach. You might hear a VC say something like, I don't know, by coming directly, we can be much more efficient. Really what we're saying is by coming directly, you cut out the competition, and therefore we'll have an easier ride towards getting a deal done. So that's a bit of honesty. Sarah, in your mind, what different advisors are worth having?
Thanks. Yeah, it's I think there's a few different questions you need to ask yourself when you're thinking about appointing an advisor. But just to touch on that landscape for early stage fundraising advice, and what advisors there are out there, it is highly fragmented, and particularly at this end of the market for early stage fundraisings. And it varies really from individual consultants who are set up independently and take on a handful of mandates and could work with you and represent you with investors, through to sort of specialist boutiques who are fundraising entities that just do fundraising and potentially would have a sector specialism, through to specialist teams that sit within larger financial services firms, like usually accountants, and that's sort of the team that I run at Cooper Parry is the latter example of the different types of advisors out there. But I think when you're thinking about your fundraise and you're thinking, do I need to appoint an advisor? The question to ask yourself as founder, CEO of the business is, do I have 6, 9, possibly 12 months to step away from the day-to-day running of the business to focus on fundraising full-time? Because it is a full-time process. Yeah, it's my job full-time. This is what I do day in, day out. Now, many founder CEOs at this stage are often very involved in the sales process of the business. Sometimes they're the main salesperson at the company just because of the way that it's evolved, and they're the most experienced. So any time that you're spending working on a fundraise, it's time maybe you're not thinking about your next big strategic sale, or you're not pushing the business forward. So thinking about the people you've got around you is really important, and playing to your strengths. And touching on the timeline of a fundraise, as I said, sometimes it does take 12 months. It's not what anyone wants at the start of a process, but it just can take that long. And that's, a good period of trading where when you first start conversations with investors and they see your budget for the year, that's potentially 9 months visibility they've had over your financial performance. Did you hit those targets? Did you miss them? If you missed them, why? And it can throw up questions around then the validity of the business plan. The best thing that you can do as founders during the middle of a fundraise is smash your targets. And that instills confidence in the investors in your ability to execute a plan. And it's also about, the project management of a deal. Who's going to hold you accountable? So, even just with putting a business plan together, for example, who's on your case saying, look, you said that you were going to write this piece of the business plan and you didn't. Who's driving that process forward for you? So someone that can sort of fill that role is really important. And to Ed's point around the fact that you're going to be negotiating with expert deal makers. Yeah, so investors, they're professional deal makers. So who do you have on your team that's your expert? Now, if you're fortunate, you may have someone in an interim CFO role, interim FD, maybe on a part-time basis, maybe if you're really lucky, a full-time basis. But again, sometimes a founder is playing that role too. And if you're lucky, it may be that your part-time, full-time FD has had experience working with companies where they've been through a fundraise, and that's going to be invaluable for reasons Greg will speak about, with quality of management information, the flow of that data, and how that can really help a deal. And they may have done two, 3, 4, 5 deals over the course of the different companies they've been working with. But the distinction with having someone like that on board versus appointing a specialist advisor is, to Ed's point, an advisor does this day in, day out. I gave the example, I've shaped over 400 deals across my career, and it's that daily dialogue with investors that you can leverage. And it's important for 2 reasons. The first is network, to Greg's point around who are you going to talk to? Are they the right people? Are they serious? Are they going to waste your time? And that insight into who the decision makers are, because that will expedite a process for you. And secondly, around that market insight. So if you're working with an advisor that's doing deals every year, they will have current market knowledge around how things are getting priced, what we're seeing in terms of trends around valuation, what comparable deals have happened in your sector, which funds have companies in their portfolio that may be a conflict. How can you structure a deal? What sort of different terms can you use to get the best deal on the right terms for you? These are all the things that a specialist advisor would be able to work through, and you'd benefit from their knowledge. So to sort of circle back to the original question around how do you find the right advisor and what should you be looking for? You should absolutely be questioning their deal experience and their network and what connections they have. Ultimately, you want to know they're the person that's going to get the deal done for you. But secondly, around resource and culture, an advisor becomes an extension of your team for a prolonged period of time. Can you work with them? Are they the person that you trust to get a deal done? Do you want them representing your business? Are you happy? Do they give you confidence that they will do that to your best ability and get a deal on the right terms for you? And ultimately, that's kind of what you should be expecting and asking of your advisor.
Cool, thanks, Sarah. I don't think I've ever been called a professional deal maker before. I'm not sure. I'm not entirely sure my boss would agree with that. But it's interesting what you said about with regards to how much resource it takes to do a deal, and I think that is massively underestimated, to the point now that when we do our investment case, so you'll have like management case forecast. When we do our investment case forecast, we actually have we put a dip in, so post fundraise. because usually what happens is the management team is so exhausted and they spent so much time on the fundraise that maybe the pipeline's not had as much love as it would have done normally. You know, they've not hired the people because they were waiting for the funding to come in. So their management case kind of assumes this kind of like smooth transition from, you know, from operations through to investment through to the next phase. Well, actually, it doesn't happen like that. So we put in this kind of Series A dip, if you like. So Ali, you're one of the advisors that we can't help but have as a lawyer. But it'd be interesting to, you know, from your point of view, what should people expect from their lawyers? When should they expect them to be involved? That sort of thing.
Yeah, so definitely lawyers have to be involved to get a deal done. Necessary evil, I'm afraid. But from our point of view, or from the lawyer's point of view, you want a lawyer who understands benching, who gets the transaction and can sort of speak to the terms and terminology, and can pick the sort of right points to focus on. And a good lawyer in this space will also have good connections to investors, will understand potential investors, can give you insight into how they see investors work, portfolio companies, can give you insight to what market practice, where you can sort of push and where you can't, or you know what they'll accept or won't accept. So that really is from a sort of value add point of view. A good lawyer can do that for you, but it's really more to sort of holding your hand, helping you through the process, helping you sort of get to the point of term sheet involvement at an early stage, where I say, but also really it's deal execution and helping you make sure you do the deal on good terms, but also making sure it's on the sort of, they focus and keep it at a high level and don't get lost in the detail, because the end goal is to get a deal done, right? Everyone here is on the same team effectively, you know, the investor and founders. The end goal is actually we're going to grow a company and we're going to grow something and we're going to have an exit, or we're going to get have a transformational business at the end of the day. It's that bigger picture in my view.
Yeah, definitely. I would note that not all lawyers are the same. You know, Ali specialises in this type of deal. You know, I've got a term sheet right now that's been marked up by a major law firm, London law firm. It's a £2.5 million Series A transaction, and they've gone and thrown the kitchen sink at it. You know, that kind of the idea that law firm is enabling this deal to happen is, you know, is completely the opposite. It's like we've agreed a deal, and the law firm seem to be doing everything they can to prevent it. And so you be careful who you choose. And then likewise, and on the other end of the spectrum, I'd say, don't go to your mate down the street that's, you know, did your last conveyancing bit of work, because there's nothing better than getting a term sheet back or a set of legals back with minimal markups from the other side's lawyers, because they just aren't used to doing this sort of work. So it's worth talking to a few lawyers and making sure that you kind of have one, so the right one for that, not somebody that's a major magic circle law firm that's kind of, you know, charge you a fortune and throw the kitchen sink, and not one that isn't used to doing these types of transactions. Won't understand what is negotiable or not. Great. Sorry, go on.
As I say, I agree that's key, and for me, one of the sort of almost in the common mistakes bucket is not having the right sort of legal advice there, because actually it ends up being more difficult to sort of close out a transaction and get the deal done. Where I'm acting, a lot of investors I now have companies which sort of haven't got a counsel who does understand how venture works. It just makes the transaction that much more difficult to get it over the line, and you find sort of a lot of where they're not guiding founders, it becomes emotional because they're very upset around things like warranties, around founder vesting terms, and then that's just makes the deal really difficult.
Cool. Don't steal my next topic, Ali. Don't steal my next topic. Hold that thought.
Ed, could I just jump in for a second while we're on the topic of advisors, and just mention a category that we haven't talked about yet, which is some form of emotional advisor. So just from an operator's perspective, the Series A is one of the most, if not the most stressful periods you will go through as an entrepreneur. You almost certainly have started the process too late. So you're looking at an expiring runway, and you're having dozens of frustrating conversations at every stage. And it's something you normally can't share with the wider team, because, you know, it affects their futures pretty dramatically. So you need to find some outlet that you trust within the firm. That might be, you know, a co-founder, it might be your CFO. Or in my case, it was the chairman of the company, who can just help you take that step back, listen to concerns, and provide a sounding board. You know, I think it's so crucial to keep a steady mind through the process, and not get too emotionally bored, which is all too easy.
Absolutely. I don't think you know, the mental strain on and stress doing a fundraising, I don't know if there's ever any studies been done, but I assume it is massive. So having someone to talk to has got to be key. Having a good mentor is probably a really good idea. I mean, in many walks of life, but I think probably going through this even more so if you can talk to somebody that's been through it and understands it. I wanted to flip back to the next bit about legals and sort of what Ali touched on, and kind of where things get stuck, where Series A's kind of get stuck on legal agreements. So I'll start for 10, which would be around lever clauses. So for those that aren't aware, a lever clause in summary is when we invest, we're investing not only in the company but very much the entrepreneurs. And what we don't want the entrepreneur to do is walk off after 6 months deciding that they've actually, want to be a windsurfing instructor in Turkey or something, which has happened. And so you have lever clauses which say that actually if you leave, a certain percentage of your shares will actually go back to the company and allow the company then to appoint a new CEO, and so it's an incentive for you to stay. But they can be very emotive, because if you're a CEO, you've worked really, really hard, and why should I give up any of my shares? So Ali, I don't know, that's my one thing that I see people surprised. It's a clause that people are surprised at. What other things do you see just getting stuck?
Yeah, it's the primary one, and it is personal to the founders. It's very emotive, I agree. You sometimes see people getting stuck on sort of the warranties, which effectively sit alongside. So when you do an investment, you have a due diligence process where the investor is effectively just looking under the bonnet, making sure of a car, effectively making sure that everything is in order and there's no sort of black holes in the company. And you have sort of warranties backed up, and warranties are just basically statements being made by the company, contractual statements, and the founders just saying, look, everything we've told you is true. We own the shares, we own the IP, there's no disputes. And if those warranties aren't true, then there's a contractual claim against the founders effectively. But if you do your job properly, you have the right advisor alongside you, so you will do a disclosure exercise, and you'll just tell the investor everything against those warranties, and then you're kind of safe. It's all about just flashing out information, tell the investor everything, so they know exactly what's there. There's no sort of surprise for once they put their investment in. But again, it can get quite emotive, because founders get very upset, like, potentially I'm going to be sued, and this is personal. And again, the wrong advisor not sort of guiding that person, it can lead to problems. It sort of gets into sort of sticky situation there. But again, the fundamental here is, from my point of view, when I'm always advised founders, it's very rare your investor is not going to sue you for the sake of suing you, because that would be nuclear, right? Because they're suing their company, and also they're suing their founder team. So if they're suing you, something's gone fundamentally wrong, and that investment's to be a write-off. So that's an area we do sort of, again, have sort of a bit of stuck on legals. What I would say is, what I would recommend is sort of when you get to your Series A, even before, just sort of engage with legal counsel anyway, and sort of think about some key things, because the key diligence issues that come up on any sort of Series A round are actually around your shares. So fundamentally, a lot of companies don't have their sort of share registers in place, which you have to have as a matter of law. Their company's house records don't necessarily tie in with what they've told the investor. You'll find there's options promised to people and they're not properly documented. Or a big thing I find is a company have said, I promised someone 5%, you're like 5% of what? So, please don't talk percentages, talk share numbers, and link it to a percentage at the relevant time. So lots of tidy up stuff like that is actually things which you can do pre-investment. That doesn't then become a blocker in the round, because it then has to be sorted out. Another thing is IP ownership. Fundamentally, you have a lot of founders that developed IP before they set the company up, and therefore just making sure that IP is actually properly vested in the company. I've had deals where I've had founders who've been working for someone else and doing sort of the business on the sides they work on, they've set up, and then you found that actually their employment contract, their employer means that employer owns all the IP. So try and sort all that sort of things out pre-Series A and make sure there's no issue there. And then when you're using outside consultants, making sure you've got written agreements to make sure the company owns all that IP. And now where we're seeing a lot of people outsourcing IP developments outside Europe to Ukraine, etc., just a written agreement may not necessarily be enough. You need to make sure you take legal advice to make sure the company owns the IP, because there could be local law which overrides that. So all those sort of things can help you, can sort of help you clear the way for Series A, and you can sort of solve them before you get in there, because they are sort of sticking grounds now, the key areas that any investor will look at. And I think, again, I just reiterate the point again, get a good advisor who understands this space well and understands venture and understands terminology, can guide you. and involve them early on. So get them involved in term sheet negotiation. It's really easy for me to pick up a term sheet. I can look at it in sort of 20 minutes. I can tell you the key things always for me are going to be around sort of valuation. Do you understand it? Do you understand how it works? Model your cap table. That's always my advice. Attach it to the term sheet. Because again, you have this terminology, you'll see, especially if you've got convertible loan notes, advanced assurance agreement, advanced subscriptions agreements. If you've got those in, and you sort of have in your term sheet a pre-money valuation on a fully diluted basis, including any convertibles, the share option pool. Actually, I've had many transactions where I've had founders that come up to the term sheet. I sit down, we model the cap tables together, and they've not realised actually that's the implications of it, and therefore they're sort of back and forth now on what they thought they were agreeing to, and that delays the transaction. So agree that up front. The other areas where we have sort of, I will always focus on are the protected provisions and the board structure. So that effectively is how is your board structured? How is the company running in terms of representation? Yes, the investor will want a board seat. Who else will sit on the board? How does that look? You want to make sure it's balanced from a governance point of view. And then the protected things are really about what you can't do about your investor consent and making sure they're balanced and looking at it from both sides of the table. So from your point of view, you want to make sure you sort of operationally run your company. From the investor's point of view, they are putting a lot of money into this company. They will make sure that then certain things they are protected against, and you have to go and seek their consent, because they're not going to control the board and they're not going to have control at the shareholder level. So it's just making sure that balance is there, and effectively just making sure it's sort of fair and balanced in between. Your Series A investment documents, and this is important, they are the foundation for your future rounds. So getting those right, getting the right protection and getting the balance is really important, because your BC all build on those documents, and they're geared towards an exit as well. So if you don't have those right, it's very difficult later on to try and sort of take things out or put things in. So it's really important to sort of get the right advice in at that point in time, and just have the documents that are sort of ready for the next round.
Oh, cool. Thanks a lot, Ali. I think that's some really interesting points, and it kind of reminds me. I would say my advice would be beware the short-term sheet. So we at Octopus, or in the team, we have a two-stage term sheet, and we have like the upfront. This is the valuation. This is the rough structure. These are the preferences. Be warned to always check your preferences. And then if we get a broad agreement, we then go into a 20-page full term sheet, kitchen sink, consent rights, leavers clauses, warranties, etc. And we do that to be fair to the company, to be honest, because a lot of VCs may give you a 3-page term sheet. You sign it, you're now up in exclusivity. They then send you the illegal agreements, which you're on the hook for the cost of, and you get all sorts of horrible clauses and things that you weren't expecting in there. So to Ali's point, beware the short term sheet. Greg, what is there anything that surprised you? I say two things really. Is there anything that surprised you on legals, or was there any sort of VC language that has baffled you that you were surprised at when you've seen term sheets?
Yeah, well, with me personally, I've been fortunate to have been through the VC side before moving on to the operator side. So I knew the dynamics of the term sheet and the legals. I think it's worth remembering the dynamics at play, because that often helps businesses understand the intention behind the legalese. So entrepreneurs are fundamentally optimistic people. They think the business will succeed, because otherwise we wouldn't be investing our lives in building these businesses. And we tend to care most about maximizing valuation and the amount we raise. And then on the opposite side, you've got VCs who are much more realistic. They obviously have conviction about making investment in the business, otherwise they wouldn't be doing that. But they know statistically most of the deals in their portfolio will have issues, and they will be fighting to get their money back. So all of that legalese tends to be around protecting investors in difficult situations. So when they talk about anti-dilution protection, they're worried about the situation where in the future you haven't performed to plan and you have to raise money at a lower price, and then VCs are it becomes clear that they've overpaid, and so they want to preserve the ownership position in some form. And there'll be a bizarre array of different flavors of anti-dilution, and we don't need to talk about them now. There's amazing advisors who can walk you through the differences between a full ratchet and a broad-weighted average anti-dilution. But you really need to understand the impact of those different terms, because they can have radically different impacts on the founders' positions. Another one, Ed, that you just mentioned that often comes up as seemingly innocuous is the participating preference share versus a more benign non-participating preference share. So again, this is where a VC is worried that you'll sell the company for not the 10x everyone was hoping for, and they want to optimize their return in that situation. So they'll take, in a case for participating preference share, they'll take all their money out first, and then divvy up the remainder according to everyone's share of the cap table. And then we've mentioned this already, but reps and warranties often come as a surprise, that there can be personal liabilities to the founders. And again, this is fundamentally the VC worrying that you're lying to them or not telling the whole truth about the position of the company that might turn out to be adverse in the future. So it's not personal. It's just about making sure there's some recourse if you didn't say something important.
The warranties claim one is really interesting. I've got a good anecdote on it, or I think I've got a good anecdote on it, because there's often a lot of talk about warranties, and really what the VC is saying is, look, you've told us these things, just back it up and say that they're true. And the truth is that warranties are actually very, very difficult to claim against, and quite difficult to prove. The standard is just to have a warranty rather than a sort of warranty and an indemnity where, if something's proven, you immediately have to pay, you have to show loss, etc. So warranties become really difficult to actually claim against. And I once asked a lawyer who'd worked for about 20 years whether they had ever seen a warranty claim, and they said once, and it didn't actually work. So I'm not suggesting that you should just ignore your warranties. That would be remiss of me to do so. But understand what they're there for and try not to get too hung up on them, in that actually, the warranty is just there to say, as long as you're not lying, then chances are that you're going to be, you're absolutely fine. But it was interesting to hear that this lawyer, I don't know, maybe Ali said, oh no, I always claim against warranties like 5 times a week. But certainly in the 20 years of this corporate lawyer that works with people like us, that they'd never actually managed to successfully make a warranty claim and had only tried once. Sarah, what kind of interesting legal points of sort of meant that deals haven't happened? Have you ever had a deal not happen because somebody just couldn't get their head around a lever clause, or wasn't keen on the brand rights, or something like that?
I mean, we've had deals that have fallen over where our clients had a change of heart, and they've sort of got into the details and into due diligence, and I guess they've got a bit frightened by a lot of the things that they're signing up for, and so they've decided not to fundraise. But I think some of the things, going back to what Ali was talking about with delays to a deal, we've definitely seen sort of tax implications that have delayed deals where, for example, potentially one of the original founders is quite passive in the business and not really involved. And at the point where they raise Series A and the investors are asking directors to sign up to things like leaver conditions and sort of the director duties that are expected, they decide at that point, actually, it's time for me to exit the business. I won't be involved going forward. And of course, what crops up then is if they're selling their shares back to the business, there's capital gains tax implications, and potentially you might need to do a different structure for the deal. So we've had examples like that have delayed deals by 3 months, where we've had to find a way and a structure that both the exiting shareholder, the investor, and the company are comfortable with. So that's maybe it's kind of a legal and a tax piece. And then to what Greg was talking through around things that often surprise companies, it's less of a legal one, but sometimes the fees that are involved with raising from certain funds, so things like arrangement fees and ongoing monitoring fees, are things that that companies haven't factored in. And when you do that scenario modeling around, okay, here's the term, what would this look like in the future? In terms of how that's going to play out over the next 5 years, and you factor in that cash leakage, if you're paying a monitoring fee of 2% on an annual basis, and then you're paying a 3% arrangement fee, for example, on initial drawdown of the money, it's those sort of cash commitments that people don't factor in or know until they start dealing with funds. So we prep companies for that up front, but it is always a surprise, that they never expect that they would have to sign up to something like that.
I would say we were reassuringly expensive, Sarah. That's the truth. Look, before we go into the Q&A, and thank you for those that have posted some really good questions, which we'll come on to. I think it would be, we would leave something out if we didn't talk about the dirty word in Series A, which is valuation. And how do you get to a valuation? I'll just talk a little bit about this in terms of what we've seen valuations do over the last 9 months, because I think that's probably a topic that everybody's like, well, how has COVID impacted us? And back in March, as COVID hit, we were kind of rubbing our hands as horrible capital or venture capital people looking for buying opportunities. And then what happened is everybody mothballed, nothing happened, and there was very little sort of activity in the market. And then in August, that sort of changed, and everyone started, a lot of companies came out and started to do fundraising. And we thought, again, rubbing up like the captures, we are rubbing our hands together, the valuations will be down and etc. And actually what we found is that for the right companies, for the companies that really, I guess COVID proof's a horrible word, but work well in the new world, which is technology companies, we haven't really seen any depression in valuations, particularly. In fact, if anything, the kind of rationale for investing in these businesses over your more traditional, maybe pubs and leisure facilities has grown and has created more value. So I think if a VC tells you that valuation, if you're running a strong B2B SaaS business that's growing, and a VC tells you, well, valuations are depressed, I would actually say they're not. And that is not what we're seeing. Competition for funding is as strong as ever, and VCs are getting used to going out there and meeting people on Zoom and maybe just doing one quick site visit, that type of thing. But the question of valuations themselves, and it comes up a lot, and the truth is it's basic economics, especially at Series A stage, and it is your valuation will be largely dictated by the competition of people that want to invest into you. There's no real formula. I mean, you can sort of come up with sort of broad brush formulas. If you're a B2B SaaS business growing 50% per annum with a good 80% margin, you might be looking at somewhere between 4 and 6 times your annual recurring revenue as your starting point valuation, depending on your market size and that sort of thing. But the truth is you'll get closer to 6 or 7 times ARR if there's lots of competition to invest in you, and you'll get closer to 3 times if there's nobody. And so the massive disparity, and that is where if I was raising money, I would try and make sure that I was building competition within VCs to invest in my company, because the other myth is that a VC will sit there with tons of opportunities and just be selecting the best one, and that isn't the case. Generally we have to search really hard for the best opportunities, and we're searching in the same pools as a lot of other VCs. So if one VC is interested in you, chances are 2 or 3 will probably also be interested in you, and therefore you should go out and build that competition, and therefore that will dictate the best valuation. I don't, Greg, do you want to talk a bit about how you found valuations, or you found valuations over time?
I'd certainly echo your comments that at the moment, I don't think there's been a better time for businesses in the SaaS and online retail world to be raising money. There is an extraordinary amount of dry powder, as they like to say, across Europe, with VC funds competing for the best deals. Yeah, I've absolutely experienced in recent weeks a lot more competitive tension than I've experienced at other points in my career. I'd also echo your points that there is absolutely no science to valuations at Series A, which is always painful for me after years of training as a financial analyst. So you can throw all your DCFs and your dividend growth models out the window. It largely boils down to the amount of money you're raising and a target percentage ownership of the VC fund. Those tend to be big drivers of where you end up with valuation. And then, as Ed says, competitive tension. So the more competitive tension you can get, the better you can strike on key terms like the nature of the preference and some of the other key elements of the term sheet.
Thanks, Greg. I've just realised I'm talking about being a tech investor, and I've got a load of CDs behind me, and that also probably that probably just shows my age as well, doesn't it? That I was very much a 90s CD buyer. Sarah, so valuations for you when you're advising people, how do you approach the subject?
Yeah, it's something that all my clients get really hung up on, and they come to us with a very fixed view on what their company is worth, and and sometimes very forward in saying unless you can raise money for us at this valuation, we're just not interested. So there's a bit of an education that companies have to go through, everything you've just spoken through. The key shift in mindset is getting away from thinking, I don't want to give away more equity than this, and remembering you're not giving it away, you're selling it. And to your point, Ed, it's kind of only worth what someone's willing to pay, and that price negotiation is hugely subjective. People are going to have different opinions on what it's worth, and the one thing you can rely on is it will be different to what you believe it's worth. And we really try and steer companies away from being obsessed with that headline valuation. And it's quite unhelpful, when you read in the press really fantastical valuations for companies that maybe break market norm and are kind of doing things outside of what you're saying is normal as an advisor. But often those press stories are talking about a valuation that could be possible in the future based on performance ratchets. So it doesn't get into the detail, it doesn't unpick the deals. So the press use a valuation, but actually there's earnouts and performance indicators in there, and they work both ways. So if a company doesn't hit their targets, the investor's going to be clawing equity back, and actually they could end up being majority owner of the business. So it's actually not that good a deal for the founders. So when you unpick a deal and you get into all the aspects, and some of the things I mentioned around that cash leakage as well, you need to factor that in. Model through, as Greg said, what the different scenarios could be in 5 years' time to your shareholding, dependent on what you're valued at in the future, and working out what feels like the best deal, but also not ignoring the fact of all the the qualitative stuff that a new investor can bring. This is a partnership. They're not coming in and just putting money in so that you can deliver a growth plan. They're coming in to also own a piece of business and help you grow it and hopefully sell it for a lot of money in the future. And they will be active in driving that. Ultimately, they're backing you, they're backing your vision, they just want to help it succeed. But you've got to remember that you probably couldn't build that business from £1 million company to a £50 million company without external investment. So anyone that's providing that capital and putting their money at risk should benefit from that growth and that uplift, because they're the ones that have injected the money to make that happen. So it's a partnership. There's value that investors are bringing beyond just the capital, and really trying to stop getting obsessed with that headline number. It's better to own 70% of a company that's got the potential to be worth a lot more than owning 100% of something that can't grow without capital.
Yeah, I'd say probably one of my least favorite conversations is that entrepreneur that tells me that they saw in the whatever press that the X CRM tool was sold at 12 times and therefore theirs is too. And we've talked about preferences a little bit, and I mean Greg's talked about it, and I've mentioned it as can be a bit of a dirty word, but actually, for us, quite often, if a company wants a really high valuation, we might say, okay, we'll have a really high valuation, and therefore, if you do so well that you're going to shoot it out of the park, and you really believe that, then you'll benefit from that. But we'll want a bit of the downside protection through our preferences, and we're happy to make that trade-off. We might have to say, well, okay, we'll have a bit more downside in order for you to have the upside that you want, but don't come to us with a massive valuation and then also say, but by the way, I don't want you to have any downside protection on it either. Like there's kind of a scale. And so I don't know, Ali, talking about that. So away from the headline valuation, what other things do you see when you think about valuation?
So I agree. I mean, for me, that the valuation point is don't get too focused on it, or look at all the terms, because your point is absolutely right. You get a massive valuation, you have a participating liquidation preference, or you have full ratchet and dilution, and then that actually valuation becomes a lot less appealing. I'm probably the least qualified person to speak to valuation, but it's good to hear there's no magic formula, no right answers. That's always good to know. And I always say to founders, look, just think about what do you need to raise now, how much do you want to raise, budget it out, work out where that gets to your next milestone, and then that will give you the opportunity to go out again and raise a higher valuation. That's how you do it. So work out your spend, work out your budget, work out where to get you to. Think about that from the point of view of, can you go out again and then raise an even higher valuation? That's how you limit your dilution, and keep your focus really on just getting you through. If you're fortunate enough to have 5-6 term sheets, great, you can negotiate. If you're in a position where actually there's not much on the table, and there's you're speaking to one investor or a few investors, but it means that your company survives and you can move forward, then you have to think about that. There's no real answer, and just try and get the best terms you can at the best valuation you can, given the time and circumstances for your business.
It reminds me of a saying that a very successful entrepreneur gave me, which was, the trouble is you can only ever sell equity once. So a lot of the time, people feel like, well, you sell the equity and it's almost like free money, because you don't have to pay it back and they've got to take. But if you're as successful as you hope you are, that £100,000 for 20% of your business when you're starting up is going to look extremely expensive when you're valued at £100 million in 10 years time, or whatever it might be. So it's always worth keeping in mind you can only sell equity once, and think hard about dilution. So I just a few audience questions. I'm not sure, we'll definitely won't have time to do them all, but let's just touch on them. And I think this is a good question for Sarah actually, and it's a really interesting one. It's, at what point in time / growth do companies usually pursue Series A, and what do you think an investor would want to see? So I'm sure you get lots of approaches from companies wanting to raise Series A. When do you say yes, that's the right time, or no, that isn't the right time for you?
Yeah, it's it's how you define it, which it can be quite subjective. How we define Series A is when a company's got to the point where a lot of the risk around the business model has been kind of eliminated. So there's a good substantial client base that are buying the product or service from the business, and that has physical proof with revenues. So if I was to talk to an investor that says they do Series A rounds, and they're saying what their requirements are and what they're looking for, there is just a number which is $1 million of revenue for a tech business in particular. So $1 million of annual recurring revenue is the benchmark for a Series A round if you're a tech software business. If you're maybe a manufacturer and you have a product, a consumer product, for example, that's going to be slightly higher because it's one-off purchases. So they'd want to see a bit more proof point. You're probably looking at somewhere between 2 and 3 million of revenue if you have a very one-off transactional type of business. But revenue traction is one of the biggest indicators. That would send a signal that you're ready for that scale up, that you're ready to have some capital injected into marketing efforts and build out your sales team in order to just do more of what you're already doing and exploit that. And the second part of the question around key items and KPIs investors want to see before starting Series A, I think it's again quite sector specific. If you are talking to someone like Ed, B2B tech investor, Ed's going to want to understand how that ARR maps out, what the lifetime value of that customer is, how that comes down over time, what your customer acquisition cost is. There's lots of sort of metrics in the license revenue that they're going to want to see. It's really important, to Greg's point earlier, to have a lot of this information already clear and ironed out before you go to investors. We very commonly see people mapping out their recurring revenue incorrectly, where they've got contracts with customers that maybe span over 3 years, but they're recognizing all of the revenue in 1 year, and sort of not mapping it out monthly or mapping it out as the cash comes in. It's just sort of thinking through how that all works. Another metric that you might want to portray is total contract value as well, because if you do have contracts that span 3 years, but you're talking about current year revenue, and then when you look at your forecast, well, actually, a lot of the revenue for future years is booked because you're mapping it against a 3-year contract that you know is signed. So just working with someone that can really look over the financials and make sure what you're accurately saying in terms of ARR is correct. Because so many times we've had to backtrack, someone thinking that they're doing over $1 million of ARR, and actually when you unpick it and map it out properly, they're at more like 700-800K. So it's a different sort of position to be going out to market with. You can probably build on that, Ed. What is it that you look for?
No, I think you did a really good job. I mean, I would be careful of hard. I am the investor that says, yeah, we want at least £1 million ARR. Which is always really annoying, but to be honest, if you're at 900 and on a good growth momentum, and I like your TAM and all the rest of it, then guess what, we're going to still talk. So other things in my world, we look very closely at sales efficiency, so LTV to CAC ratios. We look very closely at retention rates, gross revenue retention, net revenue retention, logo retention, customer concentration, etc. We could go on, we could do a whole session on KPIs, so I won't go any further. But what I would say, what I find really surprising is that I will read a 40-page, 50-page deck out and get a bit excited about the company. I'll then ask for the financials, the forecast, the business model, etc. And they'll say, we're still working on it. That baffles me. It's like, actually the deck can probably be 10 slides, and I want you to really focus on your model and understand what's driving your business, because that's what I really care about. That's what I'm going to build my investment cases against. And it feels like that for whatever reason is the technical bit that people struggle with, is the building a really high quality functioning business model, or financial forecasts and that sort of stuff. Some VCs at the earlier stages will be less bothered about that, because they're all about the concept and who cares about the forecast. When you're coming into Series A, especially for somebody like us, where we want to see true commercial traction, we want you to have thought about what is driving your business. Do all your metrics line up correctly? Have you correctly recognized your revenue, as Sarah put? How is the business monitoring what success looks like? And that piece is I would say half the time missed, and probably about half the time I will get a team saying they're not quite there yet with their business model. Don't go to investors without really thinking through it. Greg, do you want to close us out on this topic, with around what point you should approach Series A and what KPIs people look for?
Yeah, so for me, it's about predictable revenue. Have you built a product and a sales machine that can deliver predictable revenue growth? So we've touched on all of these points already, but I agree. I think it's inexcusable if entrepreneurs are going for Series A if they don't have the predictable revenue machine mapped out in a business model with the key drivers, so that you can explain, this is how much it costs me to acquire a customer, and this is how long I keep them for, and this is how much I earn from them. Because ultimately Series A is about scaling up that machine, and there's no point scaling that machine and selling the equity once, as you point out, Ed, if you're not confident you can actually deliver.
Cool, thanks. I see we're at 29 minutes. Ali, I don't want to miss you out on this topic. Have you got 15 seconds?
I will go where everyone else said. Not really my area, I'm afraid.
Okay, excellent. Guys, thank you so much to everybody who's joined us. I think about 90% of the attendees stayed on throughout the full hour, which I see as massive success. I certainly can't keep my family that interested in anything I'm saying. So thank you to everybody that has joined us. As I said, again, we will follow up the questions that we haven't answered. I won't speak for the whole panel, but certainly if anybody wants to reach out for me on LinkedIn, please feel free to do so. And thanks for joining.
Thank you.